Hey Mom and Dad, it's Mark. I wanted to do this video for you because I want to suggest a change to my recommendation that you buy the Vanguard Target Retirement 2015 fund with the proceeds from your Vanguard New York Long-Term Tax Exempt Fund. I think that is a good idea. I think a great idea would be to make the following change. Still sell that New York tax exempt municipal bond fund and use the proceeds to buy 3 Vanguard funds. The first one is the same one, the Vanguard Target Retirement 2015 fund, and that would be 69% of the proceeds. Then the second one is called the Vanguard Long-Term Treasury Fund, VUSTX, and you use 26% of the proceeds going to that one. And then the third fund is the Vanguard Energy Fund, VGENX, and use 5% of the proceeds for that. So I wanted to make a little video here to explain why I'm making a little change to that recommendation. So to start things off, let's go back and think about what do most financial advisors tell you as a retiree, relatively new retiree, what you should invest in with your asset portfolio. And Charles Schwab I use Charles Schwab just because I happen to have this chart, but virtually any financial advisor would say the same thing. It's basically the boilerplate advice, and that is a combination of stocks, bonds, and cash, with the percentage of stocks lower the more cautious you are and the older you are. And so the 3, you've probably heard this before, in fact, but the 3 sort of profiles of a retired person's investments would be moderate, moderately conservative, and conservative. And I think you fall in the middle bucket. And just to keep things, you can read this later, but just to keep things brief, this is 40% stocks, 50% fixed income, also known as bonds, and 10% cash, such as a CD. And so even here it says someone in the 70 to 79 age range. So perfect for you. And this fund that we already talked about is 40% stock. So it's actually, it would fit this category. And so that's why I think it's a good investment for you. Now, the reason I don't think it's a great investment for you, and you can read this later, I'll send this to you. The reason I don't think it's a great investment is that we've talked about this, but stagflation, as an example, or other economic conditions that they have happened in the past, in the 1970s. And so when you have a stagflation economy, both stocks and bonds will both go down. So why would you want a portfolio that just has stocks and bonds? Because whenever you have a stagnation or a growth recession, economic growth, you see stocks go down. And then if you have a high inflation rate, then bonds will go down. And that's why I recommended you have gold. So we talked about that already. I also mentioned here that sometimes you want to have commodities in your portfolio, like oil or steel or wheat. Those are all different kinds of commodities. And the reason is that sometimes there's a scarcity of those commodities, and they'll go way up in value. And during those times, there might be high inflation, and there might be kind of overheating going on in the economy. So bonds might not do so well, even stocks might not do so well. So this is actually not my idea. This is from Ray Dalio. Now you're probably wondering who Ray Dalio is. He's arguably the most successful hedge fund investor. He's also still alive, by the way, and you can even read up on him, get to know him. But this is a list of the top 10 hedge funds in terms of size. This has $125 billion assets under management. It's number one, the largest hedge fund in the world, and that's Ray Dalio right there. So that just gives him some credibility, and I think that you should trust that he knows what he's talking about. And what I did here is based on this interview that I linked here, but this is a video with Tony Robbins, and he
describe, especially for younger people.
I'm not going to replay it here, but he basically is interviewed by Steve Forbes, and you can listen to it. But he talks about this exact portfolio breakdown, which Ray Dalio recommended to Tony Robbins, and he's saying 30% stocks, 40% long-term Treasury bonds, 15% intermediate-term Treasury bonds, 7.5% gold, 7.5% commodity. That gets you to 100% total, and there's no cash in this portfolio. That's an important consideration because cash is not going to, over the long run, it's not going to give you any return. It's more just a safe place to put your money, and so the reason I break it down like that for you is that I want to use that as a blueprint or a guide for your own portfolio. And the limitation is that these are exchange traded funds that I would recommend to meet each of these qualifications. You want to invest in stocks. IVV is a nice S&P 500 stock index fund. EEM is an emerging markets index funds. Those are the kinds of funds you could do. Long-term bonds, TLT is a ticker symbol for a long-term treasury bond fund, etc. And the thing is, with Vanguard, you're limited to just these Vanguard mutual funds. That's the impression I got from talking with you. So I picked out these three funds that will basically make you whole in terms of the balance in your portfolio across these different asset categories. And you can see all of these funds have very, very low expenses. This is an annual expense. Very good 10-year average return. So this is each year, VTXVX gets 8.42% appreciation. And these other two funds, which are more hedges, they get more than 4% appreciation every single year for the last 10 years on average. So I throw in the dividends. I should note that the dividends are included in the return. So this is the 10-year return is stock return plus dividends, but they all have good dividends. So show you a little bit more detail on the three Vanguard funds. We already talked about the Vanguard Target Retirement 2015 fund. You can see it went up really strongly up until 2008. Then it's representative of the rest of the stock and bond market. So it crashed, but then it had a nice recovery. It's gone down. You're going to get in a little bit lower than where it was in October if you buy it now. So that's the stock market's. That's what you're going to have. It's a roller coaster ride. These are the main holdings of this fund, and this is important. The holdings are actually other Vanguard funds, so they basically package it together. And the percentage of each of these five holdings. The first is U.S. bonds, and that includes Treasury bonds and companies that issue bonds and mortgages. So it's not just Treasury bonds. Ray Dalio, when he says he allocates 40% to long-term bonds, he's talking about purely Treasury bonds. So this one isn't exactly the same as what Ray Dalio is recommending, but it's pretty close. And then the next category is total stock market. That's U.S. stocks, 24%. Next category is international stocks, 16%. Next category is international bonds, 14%. And this last one is, TIPS, Treasury inflation protected securities. These are also bonds, just 12%. Total is about 40% stocks, 60% bonds, 40-60. Just like we said, perfect for you in your retirement. And then the second fund is the Vanguard Long-Term Treasury Fund. Now, the reason I want you to invest in this one is because you don't have enough Treasury bonds in your portfolio. Even the bonds that you have as part of this fund is not enough to meet the allocation that Ray Dalio recommends. In fact, even with this fund that I'm recommending, you're still below the recommended allocation that Ray Dalio recommends, but you have so much cash in those certificates of deposit, and cash is closest to a bond. So I think it kind of to me, what I'm recommending is the right breakdown. But you can see this is up and down, and the overall return is lower than the target date fund. But over time, it's done pretty well. It's paid a nice 2.96% dividend, and you can see the holdings. These are just the top 6 holdings, only 19% of the total holdings, but they're all just different treasury bonds. The third is the Vanguard Energy Fund, and basically follows the price of oil. Went way up in 2008, then it crashed in 2008, 2009, then it went up again in 2014, then it crashed, and so this is crashed again. You're kind of getting it in if you get in now on a low point, possibly, and it's kind of a contrarian time to invest. Everybody's negative on this energy space, including me. I'm kind of been negative on it, but that's usually the best time to invest. But it's not so much the timing; it's just you want some of this in your portfolio as a hedge for a time when commodities become very scarce. And you can see the holdings, just a bunch of large energy companies, and these are the most well-known, stable, good quality energy companies in the world. I should point out that these are stocks. So when you're investing in this fund, you're investing in stocks. You're not investing directly into commodities like oil. But to me, they're going to move the same. They're going to, this is basically following the oil price. If you superimpose the oil price, it's just about the same. And so I kind of talk through each of these assets. Stocks, you got that covered with the Vanguard Target Retirement Fund. Bonds, you've got that covered with the Vanguard Target Retirement Fund as well. You also have the Vanguard Long-Term Treasuries. Gold, you have that covered with the that BlackRock IAU in your non-Vanguard account. And then commodities, you got that covered with Vanguard Energy Fund. And then cash, as I mentioned, I have a little link here to another Ray Dalio article. I'm not going to click it, but cash isn't the best investment, but for you guys, I think it's a good sort of source of emergency funds. So I totally I totally agree with your decision to invest in the certificate of deposits. And so this is a summary. You have that chart I showed you before with each of the asset categories and the percentage that Ray Dalio recommends, and then your money. You're going to basically replicate this with these individual funds. By the way, the intermediate term bond, there's actually a Vanguard fund that invests in that, but it's so similar to the VUSTX. It overcomplicates things to try to invest in both. But that's about it. I hope you follow through. Oh, one more thing. How much of each Vanguard fund should you buy? So you're going to sell that municipal bonds fund that you currently have, just sell it all, and with the proceeds, you're going to split it into 3 funds. And I give you 4 options because I actually put a little played around with these different options, and I wanted to see sort of what's the stock bond split. The first one, as we said, if you just invested in the Target Retirement Fund VTXVX, it's 40% stock, 60% bonds, and then I tried these other 3 combinations and calculated how much stocks and bonds that would result in. I like option 2. That's the bottom line. 69% of the Target Retirement Fund, 26% of the Treasury Fund, and 5% of energy, and that gives you a nice 33% stock, 67% bonds breakdown in your Vanguard portfolio. Then you have other stuff with the gold and the cash and the certificate of deposits. So all in all, I think if you include all of that in one big pot of soup, it's just about this good similarity to Ray Dalio's suggestion. So that's the last page, and hope you like it. And you don't have to do this. It's just my suggestion. But I think it might sound a little bit. I didn't mean to do that. It might sound a little bit complicated, but it's just really just to protect yourself from some kind of unexpected change in our economy. All right, good luck, and I'll send this to you in an email as well. Bye.